I expect gold to continue to rise based on the back of these continuous string of policy mistakes by the Fed that, is now in a trap of its own design, and it can't escape. And so the result is ultimately going to be a dollar crisis and a sovereign debt crisis. The people who think that you can ignore gold's rally because the bond market isn't collapsing, the dollar's not collapsing against other fiat currencies, that's all wishful thinking. All this stuff is going to happen. The fact of the matter is people are losing confidence in all fiat currencies, not just the dollar.
In today's news recap, gold price consolidates below $4,000 as the Federal Reserve cuts interest rates. The gold market is bouncing around $4,000 an ounce as the Federal Reserve lowers interest rates in line with expectations, but provides little forward guidance. As expected, the Federal Reserve cut interest rates to a range between 3.75% and 4.00%. The central bank maintained its stance that the U.S. economy continues to expand at a moderate pace and that inflation remains elevated. However, the central bank also continues to highlight a renewed focus on the labor market. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment rose in recent months. The central bank said in its monetary policy statement, which was relatively unchanged from previous months. Although gold saw some modest volatility in the initial reaction to the Federal Reserve's monetary policy decision, it treaded water just below $4,000 an ounce. Spot gold last traded at $3,987.10 an ounce, up roughly 1% on the day. The monetary policy statement also noted that the central bank has stopped reducing its balance sheet. However, Powell had signaled this move in a speech a few weeks before the meeting. Analysts note that the makeup of the vote could be the most interesting feature of the latest monetary policy meeting. In no surprise, President Donald Trump's central bank nominee, Stephen Moran, voted for a more aggressive 50 basis point rate cut. However, Jeffrey Schmid voted to keep interest rates unchanged. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
So speaking about gold, right? Gold was completely MIA at the Federal Open Market Committee meeting. Now, considering the fact that gold is the main monetary asset, central banks now have more gold than U.S. Treasuries, foreign central banks. You would think that the rise in the price of gold would at least have deserved a question. I think it should have been front and center. I mean, the Fed should have to address that elephant in the room. But no, the topic was never even discussed. And I've mentioned on my podcast that Alan Greenspan, who people call him the maestro, and he's still held in high regard, including by a lot of members of the Trump administration who speak about him. He specifically said that gold was his barometer of whether or not he got interest rates correct. That even though we weren't on an official gold standard, unofficially we were, because Alan Greenspan still looked towards the price of gold as a market indicator of whether or not rates were too high or too low. And so what he told Congress was $400 gold meant he was too loose, and $300 gold meant he was too tight. And so he was kind of eyeing for around $350. And so if the price of gold stayed around $350, that would indicate to him that he had got interest rates about correct. Well, if $400 gold meant that Greenspan was too loose, what does $4,000 gold mean now? What is that saying about the Powell policy? Clearly, if 400 was represented too loose money back in the 80s, well, then 4,000 certainly must represent the same thing now. And so that's why it should have been brought up. And by the way, my last podcast, I titled it Gold Test $4,000 Support. And some people might think, well, obviously it failed the test because now we're below 4,000, which is the case. We did end up falling below it this week. And in fact, gold closed below 400 today, although it did trade above 4,030 this morning. But it closed below it. As I'm speaking, we're up about $20, but we're still just below 39.50. But also on my last podcast, when I talked about 4,000 support, I did say that it was very likely that gold would go below 4,000 and that 4,000 could be support even if the market was to go below. Because I think it's going to be similar to the way we handled the 3,000 support. It wasn't like 3,000 was some line that we couldn't cross. And the same thing with 4,000. We get below it. But whenever you get below it, you are in a support zone. And just like the market never fell too far below 3,000, I don't expect it to fall too far below 4,000, nor do I expect it to stay below 4,000 for any long period of time, because that would give too many people the opportunity to buy it below 4,000. And I don't think that's going to be the case. So I still think that we're at 4,000 support, even if we're trading at 3,950. I mean, we're close enough to 4,000 to say this is where the support is. Obviously, the resistance now is closer to 4,500 because we did get up to, I think, 4,400, because we got up to like 4,380. So we didn't quite trade 4,400, and then we had the pullback. But even with the pullback, where the price of gold is today is considerably higher than it was the last time the Fed cut rates. And the fact that the Fed is cutting rates and the gold price is going up is not a coincidence. Gold is reacting to a Fed that should not be cutting rates. Rates are too low, and the Fed is making them lower. And so the rate cuts are a mistake, and gold is clearly signaling that it's a mistake. Yet none of these journalists who are invited to ask, Powell questions understand enough about money or economics to ask the question or to point out that gold is flashing a warning, or they don't understand the warnings themselves, right? Because, they have to flunk a test on economics before they could be a journalist, an economics reporter at a lot of these newspapers or television networks. And then, then they get to ask these questions.
In today's news recap, LBMA's new database for gold bars will be mandatory for listed refineries from 2027. Gold refineries accredited by the London Bullion Market Association will be required to provide data to a digital platform from 2027 to increase transparency in the industry, the association's head said on Monday. The LBMA, which oversees London's over-the-counter gold trading hub, the world's largest, is pushing the market for more transparency as the gold price has risen 55% this year and hit a record high of $4,381 a troy ounce on October 20th, with broader concerns about U.S. tariffs adding to overall turbulence. We will have voluntary periodic reporting from January next year, moving to mandatory in 2027, LBMA CEO Ruth Crowell told the association's Precious Metals Conference in Kyoto, Japan. I'd say, you guys, that LBMA's move toward mandatory gold bar data reporting marks a major step for transparency in the bullion market. A centralized database will strengthen traceability, enhance ethical sourcing, and increase investor confidence in the integrity of gold. The association launched the Gold Bar Integrity Database in January for faster data collection and data processing from refiners, which are on its good delivery list. Being on the good delivery list provides access to the London market, requiring refineries to source the metal responsibly. As of now, refineries report data on the country of origin of the material they source to the LBMA once a year. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
A great time for you Bitcoiners to go cash out your Bitcoin and get some of the gold on my new platform. And then you'll be able to use your gold in ways that you could never use your Bitcoin. It'll actually work. It'll actually solve the problems that Bitcoiners pretend Bitcoin can solve, but that it can't. And, when it comes to Bitcoin, too, I've never seen a consensus trade where there was more faith that you couldn't lose. There's so much conviction in Bitcoin. Not only do they think they can't lose, but they're guaranteed a huge gain. Bitcoin's not just going to go up. It's going to 10x. It's going to 100x for sure. You can't lose. And, you've got the president behind you. You got Wall Street behind you. I mean, you've got everything going right for Bitcoin. Nobody is negative. When you get a market like that, it really can only go in one direction because everybody already owns it. Since it's so obvious Bitcoin can only go up, then why would anybody not own it? Why would the people be waiting to buy it? They just buy it now. So everybody is already in. And so the question is, who's left to get in? Nobody. Well, what happens when people want to get out and there's no new money coming in? The bottom drops out. That's where we're headed. Gold is nowhere near that. I noticed I was watching CNBC. They had Jeff Gundlach interview. And he's been bullish on gold, and I'll give him credit for being bullish on gold. And now he's not as bullish because he was 25% gold before. And now he's saying 10% because he thinks it's too high. Well, I think it's already pulled back. But 10% is fine allocation because he said another 5% in base metals. And then he still recommends foreign stocks, emerging markets. So overall, it's still a good idea, but he shouldn't be less bullish on gold just because more people have decided to join in because it's still the tip of the iceberg. It's still very early. And even though more people are bullish on gold, hardly anybody owns it. Now, yeah, people own gold in their jewelry. People own gold in their cell phone or stuff like that, but they don't own it as an investment. I would say more Americans bought Bitcoin as an investment over the last year, by far, than who bought gold. So Bitcoin's the crowded trade, not gold. If you own gold, you're still alone. Right? It's pretty lonely out there. There's a few more people who are stepping up, but the crowded trade and the consensus trade is in Bitcoin, and that's going to blow up. Anyway, let me just get back to the FOMC meeting, because while there were no questions about gold, there was a lot of discussion about the stock market and AI and tech stocks. Some of the reporters were asking Powell, are you concerned about the valuations in tech stocks? And do you think it's related to your monetary policy, right? I mean, and he basically said no. He said he doesn't think that interest rates are affecting AI stock prices, which I think is ridiculous. I mean, obviously, cheap money is fueling the mania, and without it, you wouldn't have the fuel. I mean, he said they don't really care about 25 basis points, which may be true, but in the scheme of things, rates should be a lot higher. And the fact that they're a lot lower than they should be is a big factor. In fact, one of the reasons that you can afford to make all these capital investments is because the cost of capital is low. If the cost was much higher, then they wouldn't be doing it. And ironically, a lot of these investments are being made to replace labor. So the Fed is making it cheaper to automate and to eliminate workers in favor of machines. Maybe if interest rates reflected a true market level, that we wouldn't be doing as much of this yet. Maybe we'd rely more on humans. In fact, two companies this week, UPS and Amazon, announced major layoffs. I mean, tens of thousands of people being laid off. And I think it's mainly because they don't need them anymore, right? Because they are using AI a lot more. But Powell didn't seem to care. He was asked if he thought that the stock market was too high or if he was worried about overvaluation. And he said, well, we really don't pay much attention or care about any individual price, which, of course, he wasn't asked about an individual stock price. He was asked about the entire market, right? The market, the stock market being overvalued is a big deal. It's not like one isolated price. It's this huge market, right, that has major implications for the economy if the market were to tank, right? But to say that, well, it's just one price, so who cares? He goes, we pay more attention to the totality of the market and of the economy, rather, and the credit system, without recognizing how intertwined the stock market is, especially considering that today NVIDIA not only hit a new all-time record high, NVIDIA now has a market cap of over $5 trillion. $5 trillion. To put that into perspective, there are only 3 countries in the world that have a total stock market capitalization. That means all the publicly traded stocks in the entire country. There's only 3 countries where the whole stock market is worth $5 trillion. The United States and China. And the third one is Japan. But Japan is only worth $5.4 trillion. NVIDIA could be worth more than Japan by next week, right? This is an amazing statistic, but it's also a very scary statistic. I mean, the whole U.S. stock market capitalization, I think NVIDIA is about percent of the whole U.S. stock market is one stock.
What do you think of today's show? Do you believe that the current gold and silver sell-off is some sort of coordinated attack against the metals, or on the contrary, is just big players taking profits after an abnormal rally? Post in the comments section your plan for gold and silver, and share with the stackers if you are taking any profits after the mega rally we experienced this year so far. Now, peep this video right here because it's a perfect fit for you, and I'll see you on the other side.